I host a show called Fast Money, and what you guys do is the exact opposite. So this is going to be a bit of a challenge. But we had the pleasure of having a conversation yesterday. I got a chance to get acquainted with many of your views. And what I thought was really interesting was the change in how you all look at the future and how underlying factors might change the environment, which is very important to understand when you're allocating for the long run. So Tina, can you walk us through what sort of environment do you anticipate there be in, let's say, 10 years compared to what we're seeing today?
Yeah. Well, thanks for that question, because it is important to distinguish between the cyclical and structural. Mm-hmm. And because I actually have different views. I think on inflation, which is what everyone's talking about, I think that they'll probably will see, inflation come off the boil in the next year or so. But structurally, there are a number of things. And, when Jay Powell spoke in Jackson Hole, there was a lot of reprisal of Paul Volcker. And Paul Volcker, and this may be a little sacrilegious, is kind of seen as this god that single-handedly slayed inflation. And what's not fully appreciated is the underlying trend that allowed inflation to essentially be a non-factor. And those factors are either reversing or have stabilized, and they are. He was obviously helped, unlike his predecessor, Arthur Burns, he was helped by, the economic orthodoxy of Margaret Thatcher and Reagan. He was helped by the end of the Cold War, which led to the opening up of China and Eastern Europe, which led to a massive labor supply shock, which obviously reduced wages. He was helped by the entry of China into the World Trade, WTI in 2001. Massive technology-induced supply shock, which interestingly enough benefited from research done during the Cold War, which was commercialized after the Cold War, which led to the internet age, etc. Another labor supply shock, the entry of women and baby boomers into the workforce. All of those things are unlikely to be repeated again. In fact, some of them, one could argue, is reversing trade globalization. The impetus obviously was to find the lowest cost of production. Today it's more about cost is important, but it's balanced against security of supply and availability of supply. All of those things are inherently inflationary. It doesn't mean we're going to see the prints that we've seen this year, but it also doesn't mean, that we'll struggle to get to 2%. You're likely seeing a long-term inflationary trend of, 3 to 4%, even 5%.
And that changes dramatically how you view assets and how you value assets over the long term. So Anastasia, I was wondering, in this, if that's the regime that you are in, and rates also remain higher for many reasons relative to where they have been, then how does that change your view in terms of allocating your portfolio?
For a large pension fund like us, the real problem is if you don't have growth, because we're geared towards growth. We are long-term holders of equity, public equities, and also private assets. So when you also have a large fixed income book like we do, which is supposed to diversify you, but it doesn't, so that is problematic. So for us, what that's meant is we've been a little shorter duration than we otherwise would be versus our benchmark. And the reason for that is we're large and it's very hard for us to market time anything, but we're shorter duration purely because it doesn't pay to hold risk right now. And that's why, on the margin, fixed income is de-risked for us.
Right. Ed, you were speaking about that yesterday in terms of the challenge that we're facing when bonds are no longer the diversifier that they had been for so many years.
So I think that's the big question right now for a lot of institutional money managers is just how you think about portfolio construction at a strategic time horizon. We were very lucky over the last 30 years. Inflation was relatively muted, and most of the change in asset prices was as a result of changes in growth expectation. So in that kind of world, bonds can act as a diversifier. Bonds actually provide insurance or protection against your equity portfolio. If you think about what the world looks like going forward, one of the things we're struggling with is literally how variable is inflation going to be. I'm not as concerned about the overall rate of inflation as long as it's stable. But if inflation starts to explain a lot of the variance in asset prices, then stocks and bonds won't be negatively correlated anymore. They'll be positively correlated because inflation shocks hurt both equities and bonds. So that really starts to change how you think about long-term portfolio construction and the attractiveness of fixed income within your portfolio. So we're trying to figure out, hey, what could cause inflation variability to be persistently higher than it's been in the last 30 years? Mm-hmm. That's, I think, the thought experiment.
What's the number one factor right now?
Well, the number one factor by far is central bank credibility, because that is what has caused inflation to be so under control. And so far, at least through this cycle, you're still seeing a lot of confidence in central banks. If you take a look at something like the five-year forward inflation expectation, it's still relatively well grounded between 220 and 230. That's pretty close to the Fed target, so that means, by implication, the Fed still has credibility. You start pushing that out to other central banks globally, seeing what's going on with the Bank of England lately, then you can certainly see forces that might push that credibility into question.
Yeah. Somebody made a point the other day on air, Mohammed El-Arian, advisor to Allianz, had said, in the past, central banks and policymakers, they were able to dampen volatility, but today they are amplifiers of volatility. They seem like very difficult opponents to go up against, Anastasia, when you're trying to think of how are you going to invest and you have these external forces that are just doing what they're doing, buffeting you here.
Well, I think he's absolutely right that since the GFC, central banks essentially threw unlimited liquidity at the market. So there was no distinction between assets. Good or bad, everything was going up together. Now they're facing a problem where they're raising rates and they're also trying to pull back the quantitative easing. So it's a liquidity event from both sides. So you not only do you not have free money, you also just have a massive decrease in liquidity. And now I know they're paying very close attention to that because they don't want to cause a crisis, but I'm actually, to your point, I'm a little bit surprised that the market is so complacent about inflation. I agree that it's mostly the stability of inflation that is the issue. To me, there's no magic in the 2% number, but certainly if you have unpredictable inflation coupled with uncertain growth, that is an issue. And if they, don't get it right, they could potentially cause a liquidity crisis in the market that's already facing growth questions.
Yeah, I think the perception of, there was a time we thought central bankers were super people, or supermen, most of them were men, right? And because they seem to cure every ill that the economy faced so effectively. And that's actually my point. Someone wrote something, it was called the end of magic money, in the sense that what's really ignored is a structural backdrop that allowed them to be so effective. Mm-hmm. And that's what I think is changing. So for example, you know, if you think there is a geopolitical premium attached to asset prices, well, that premium, you know, starting with, let's say, Glasnost to today, was kind of a nothing. It's all like inflation. Today, that's not the case. And so, you know, it's not just volatility of inflation, but I think, you know, we have to get used to volatility of asset prices, period. Because the sort of serene geopolitical environment, and there were obviously conflicts, but the ability to sort of corral globally a coalition of the willing. Contrast, I don't know, the first Iraq war in 1990 and the ability to corral an invasion, subdue it quickly, to today with Russian invasion of Ukraine and the impact of that. That's the difference between the world of yesterday and the world of today.
Yeah, I think it's an interesting point when you take a look at some of the big secular forces that have been in play over the last 30 years and how those might be turning around. And certainly one is globalization. Deglobalization is the new buzzword. And when you're thinking about portfolios again and where you're going to earn returns in the future, that's going to be a headwind everywhere, I think. If countries have to nearshore, if companies have to nearshore, that's an additional cost. That's kind of an inefficiency from a growth perspective, which puts a kind of tax on the system overall and makes returns harder to achieve or growth harder to achieve for the central banks. At the same point in time, if you have some of those broader forces changing, China was a huge productivity boost globally in terms of growth. If that's starting to go the other way, central banks can perceive that. So central banks could perceive China coming online and they could realize they can run monetary policy a bit more easily than they could without raising inflation. Presumably the opposite is true. If you no longer have that in place, then maybe you have to run monetary policy a bit hotter at the same point in time that you have growth, arguably sustainable growth levels going down. It's not a great mix from an investing climate perspective where you're looking at raising your discount rate at the same time you're lowering your growth expectations. Yeah. And that'll be a challenge.
Just from the investor standpoint, in terms of thinking about places like China or thinking about how the world is a little bit less stable geopolitically in terms of our relationship with various countries, how do you view China at this point? And I know, Ed, yesterday you're talking about, this is really interesting, I thought, that it's great in a way because it becomes less correlated once our relationship breaks down, but there's a line in the sand where that tips and it goes badly.
Yeah, so it's a multidimensional problem, as you just pointed out. You can think of markets globally becoming less globally integrated, and from a portfolio construction standpoint, that could be nirvana if you have all these independent markets operating efficiently, and you can diversify well just through splitting your asset allocation across all those different markets. Your diversification pickup from a portfolio construction standpoint would be greater. At the same point in time, the Ukraine-Russia conflict brought out some stark realities in terms of weaponization of the US dollar, in essence. Russia used to be part of the EM index. On the back of Russia's invasion of the Ukraine, you literally had forced disposition if you followed like an MSCI global EM index, disposition of Russian assets at zero. That wasn't in our data set. It wasn't in, I don't think, very many institutional investors' data set, but it is now. Now you have to suddenly think, where could this happen again, and what do I have to do to protect myself against that eventuality? It's a really big, nasty left tail in terms of the return distribution, and you have to make sure that your portfolio construction is robust against that.
Yeah. Anastasia, are you allocated to many other countries? How do you view that sort of allocation at this point? in terms of risk?
So, having grown up in an emerging country, I have a bias against EM for the very simple reason. I actually think that right now there's a lot of differentiation between economies, so it presents opportunities. But my own bias is I like to operate in countries where I trust the rule of law, and I know the rules are not going to change, which in the EM is not necessarily the case. So arguably, you should be paid a premium for it. But the way I think about Russia and China is very different. We never made a bet on emerging markets for the reason I stated. But Russia is small. It's a huge energy power with nukes. So it's important from that perspective, but it's not really connected to the world in other ways. China is very different. I think you cannot ignore China, and corporations can't ignore China, investors can't ignore China, because if you want to ignore China, you also are going to ignore all the partners that China has, either in Asia or in other parts of the world. And for that reason, we have an allocation to China, but it's much less than even the index exposure would suggest.
I would assume that you'd be willing to pay more, a premium, for liquidity, though, in this environment.
I think everyone would want to pay more for liquidity in this
Yeah.
environment, yes. If you take a look at the big disasters that have befallen investors globally, it's almost always related to a liquidity event or a mismanagement of liquidity. So liquidity is always at a premium, and especially at points where you have heightened dislocations in the markets. I think China's a very interesting example, though. China right now is 20% of global GDP, probably going to 25% of global GDP by 2035. And as Anastasia mentioned, you can't ignore China if you're trying to understand global growth and you're trying to understand global markets. At the same point in time, most investors are probably uncomfortable betting proportionally to GDP for some reasons like liquidity. You probably haircut your allocation because of liquidity. You haircut your allocation because of geopolitical risk. So you kind of walk it back and trying to figure out where you're comfortable in terms of overall allocation. Right now we're roughly 10% China, which is market cap weighting, full market cap weighting to China. Free float weighting is obviously much less than that. But I think it's a question that we'll continue to struggle with, others will continue to struggle with over time as to where to set the appropriate level of exposure to an economy that is a big and important one in terms of the global economy, but still has some kind of idiosyncratic risks associated with it.
You guys are all long-term folk, and we've been talking a lot about just sort of investments on a macro basis, but I wanted to get your take on equities and where we are right now, because there's a real sort of, for investors, a difficult time where you're dealing with rising rates, you're dealing with a very uncertain, landscape globally, and you're grappling with valuations with an S&P 500 that's around 17 right now. It just doesn't seem quite right. And so I wanted to ask you about Stanley Druckenmiller, who predicted earlier during this conference that Dow wouldn't be much higher from where it is right now in 10 years. You're long-term people, so asking you about this prediction I think is fair game. So Tina, what do you think about
Let me just
that?
said that in 10 years we'll be much lower than we are today. Is that, I missed
The Dow won't be much higher.
won't be much higher.
Right.
I see.
I mean, in
I
your
don't
in
know.
your your prediction, right? Inflation will be structurally higher.
Yeah.
Rates will presumably be higher as well, and so shouldn't valuations
Well,
remain in
part of the struggle I have with that is if you strip out the FANGs and you actually get to 13 times earnings, and so I think, look, it'll be a tougher time to get to earn return, but I can also make a pretty bullish case. I mean, there are a lot of contingencies that have to be put in place. So for example, I think part of the issue is, and we were already seeing a rise in CapEx, is that we need more investments in infrastructure for any number of reasons, for energy security, for sustainability, et cetera. And you're already seeing a huge, pickup in infrastructure. That actually could lead to kind of another Goldilocks era in 9 to 10 years. Again, there are a lot of players that could mess with that particular. So I don't know if I'm comfortable in saying that we will be at the same place in 10 years.
Take a little bit more of an optimistic view. There's the hope.
I think
There's
we'll
hope.
need to go through a lot of pain
Right.
in the interim, mostly because, look, we haven't seen this environment for a long time. And so you have a lot of reaction functions that are out of step with the moment. I would argue what is going on in the UK is exhibit A of that, right? And so, but I think once there is a realization that, okay, we're in a different inflation regime. I mean, when I was an allocator in the dark ages of the early 1990s, we modeled inflation at 3.5%. So, the world won't fall apart, but I think it's just the pain of getting there. And there are a lot of good things if we can, we have a shortage of CapEx. That can lead to a lot of growth.
Right.
And a lot of earnings once we get there.
Can I provide a slightly different perspective, which is that as a long-term investor, one of our main jobs is to harvest risk premiums across the markets. And if you think that neutral rate of interest is something like 3%, and you add on 4% or 450 for an equity risk premium, you're looking at 7.5% expected return. Now, I'm not going to quibble about 100 basis points plus or minus. We can all argue about that. But over 10 years, that compounds in just a huge fashion. So over 10 years, that'll double the starting value of your portfolio roughly. So if you're, and sorry, I don't want for a second to be at odds with Stanley Druckenmiller, because that's probably a really bad thing to do from a betting perspective. But if you're going to bet that we're not going to be any different than 10 years, then you have to have a really pessimistic view on the present valuation of equities. And our internal models have them roughly fair value. Huge confidence band around that, plus or minus 20%. Again, you can pick your level. But if you're roughly fair value right now and you have 10 years of compounding at that kind of rate, that's kind of our job to harvest that, and I wouldn't necessarily want to bet against that.